Hey everyone, welcome back to the Price Action Labs YouTube channel, right? So here I'm going to be going over one of the most frequently asked questions, right? What is the most powerful indicator you can use as a day trader, and why is it that some key levels hold and some don't hold, right? So this is something I get, and I've actually kind of opened up my mentorship. So I've got a few spots open for the mentorship, around 5 to 10 spots. So this is not obviously a pitch for that, but for anyone's interest, I'm getting questions on the mentorship. How does it work? Just a quick rundown of that. It's going to be free one-to-one sessions, private course, private Discord, live trading, and pre-market game plans with after-market notes and case studies. So for those who are interested, it's not open for everyone. If you are interested, just drop a video somewhere, drop a comment, below, and I'll happily send you a link for that. But what I want to go over in this session is the bottleneck that traders have, which is basically using indicators correctly, right? So let me tell you something about indicators. You don't need any of them because we are reading price action. The indicators you see on your screen are merely just to make reading price action simpler. So we're going to be going over how I framed this particular trade, right? So in the Discord, the way that I kind of set this trade up, just looking at this from the private Discord that we do have, my pre-market game plans are very simple. I look for time and I look for price. So what was going on over here, if we look at this chart, this was my pre-market game plan, right? So I'm looking for certain areas of fair value gaps and I'm looking to see how price can react to them, and I'm looking for trades, right? So this is my exact pre-market game plan. So I am looking for price to come into the value gap you can see before heading higher, and we're going to go over this on the charts very, very shortly. So of course, this is the trade that I took. It's around $400 in the space of only 20 minutes. I think it was something quite short. So now let's go over to the charts and understand exactly how we did this. So what we're looking at here essentially is, if we just kind of zoom out a little bit, what are the two indicators that I am using? So the only two indicators I'm interested in is the Asian session range, which isn't really too important, but it's good to have that. And the second is this PO3 indicator. So the PO3 indicator was really based off two time frames, right? Let's just zoom out and understand, right? So on the weekly time frame, we understand we are heavily below the weekly opening price. So the weekly opening price is all the way up here. So we are well below this weekly opening price. Now, when we're well below the weekly opening price, we want to position ourselves to take buys, right? We want to be buying below the weekly opening price. Now, similarly, we're going to be looking at the power of three in terms of the daily candle, right? So this is the daily candle. What do you need to understand with the daily candle? Well, it's really, really simple. We had open, high, and now price is looking to create the low of the day below the daily opening price, and we look to catch some kind of an expansion to the upside. So how do we know price is actually going to reverse, right? That is the golden, that's the $1 million question, which is what we're going to be going over right now. So my step-by-step process is very simple, and we're going to be going over that in this video. So I'm looking for a 15-minute fair value gap or a key level. The next thing I'm looking for is I'm looking for a price to enter this area. So I'm looking for an entry, and I'm looking for an order flow, which is basically the confirmation, right? So I'm confirming every trade with the order flow. This is very important to understand. So 15-minute fair value gap, 1 minute for entry, and I'm defining everything with the order flow. So let's break this down. So we have a 15-minute fair value gap resting over here. So this is our 15-minute fair value gap. So I get some questions about this fair value gap. So how do we qualify our fair value gaps? Well, it's really, really quite simple. We need to understand where we are in terms of our overall structures, right? So we have a structural leg resting over here. This is our structural leg low. This is our structural leg high. So anything below the 50% level is a discount. So this is where we're targeting. So this is a fair value gap. Notice how this fair value gap is also below the daily opening price, and it's also left a fair value gap just over here in the previous New York session. So when you're looking for key levels, you always want to look for where you are in terms of the daily power of three, whether it's left a fair value gap, and ideally we want to be below, of course, the Asian range low as well. This is what creates high probability trading conditions, right? So you need to know where to trade from. This is step one. Now step two, we head down to the 1 minute time frame. So on the 1 minute time frame, what we're basically looking for is we're waiting, of course, for market open. So let's just go to market open, which is 9:30 Eastern or 2:30 p.m. UK time. So what we're really looking for here, very interesting, is yes, we're significantly below the daily opening price. We see this massive red candle. So what we're looking for essentially is we're looking for this, right? So now that we have our 15-minute fair value gap, right? That's kind of step number one to the overall strategy. We have a 15-minute fair value gap. Price is now tapped into this 15-minute fair value gap on the 1 minute time frame. Now on the 1 minute time frame, the thing we are looking for is our order flow. So how do we determine order flow? So order flow you can only really determine from footprint charts, and we're going to be going over footprint charts right now. So one question I often get is, what do I use for my footprint charts? How do I kind of read order flow, and what is the name of this indicator? So just to give you some heads up, it is not an indicator. It is the ATAS platform, ATAS. That stands for Advanced Trading Analytical Software, ATAS. So what you're looking at is the same exact price action. We have this same key level resting over here. This is the exact same key level. Now from here, when price gets into our key level, we will go down to the 5 minute time frame, and we will begin to look at the order flow. Just to give people a heads up, I do not spend the full 2 hours or 1.5 hours staring at footprint charts. That will burn my eyes. I'm only looking at key level. So now we're inside of a key level. You want to understand one thing, and I'm just going to go back to the regular candlestick charts to explain this. When we come into a key level like this, right, and I want traders to understand this. So when we come into a key level, say this is our 15-minute fair value gap, right? We are looking for this basically. We're looking for a very, very simple pattern. And traders often get this mixed up, right? Because they try to find patterns inside of fair value gaps, right? That is wrong. You're not looking for any kind of pattern. You are looking for the order flow within this region. So basically what you're looking for is you're looking for aggressive sellers. So you're looking for what we call negative delta. Negative delta is very important. That's the first thing you're looking for. The next thing we're looking for is a finished auction, right? We're looking for a finished auction. Right, and finished auction does tie into what we call volume, right? So these are the three things we look at when it comes to trading, right? We look at negative delta with no reward. So I'm just going to add that over here. So negative delta, we don't want any reward. We're going to be going over what that means. Negative delta, no reward. We want to have a finished auction, and the finished auction specifically will be all the way down here, and also the last final rejection points over here. And we're also looking for a decrease in volume. So basically what we're looking at is as price comes down into the zone, we see a lot of heavy selling volume. So the delta is negative, right? So we're seeing a lot of this negative delta. So this negative delta actually doesn't get rewarded. So we're seeing a lot of aggressive sellers over here. None of them are being rewarded. So when we go to the regular let's go to the footprint chart and understand what I mean by this. So when we go to the footprint charts, we're looking for price action at this exact key level. Now, this is what's really interesting. When we go down to the lower time frames, we're basically analyzing this in terms of buyers and sellers. Now, this may look like a lot of numbers, but in reality, it's not. So my ATAS settings, for those who are interested, is you are looking for the delta profile. The delta profile is the most important thing in the trading. And what delta means is the difference between the ask and the bid, right? This is very important. So the bid and the ask represents aggressive sellers and aggressive buyers, and the delta profile represents the difference between the two. Now from here, when we go down and we look at regular kind of order flow, what we can see over here is we're gonna be reading these numbers, right? And we're gonna be understanding what's going on over here. Now, you don't even need to read every number. You need to get accustomed to looking at the delta profile. So what we see is we can see different shades of red, and we can see different lengths of the rectangle. So what this shows us is it shows us the magnitude of the difference between the ask and the bid. So when we have a red delta over here, a red delta means it's kind of intuitive to understand that there's more aggressive sellers than there are aggressive buyers. So when we come into this zone, we are seeing a large number of aggressive sellers. If we zoom into these candles, we're seeing a lot of aggressive sellers down here. We're seeing a lot of aggressive sellers down here. Now, you only need to read one or two of the numbers to get a gist of what's going on. So here we had 230 for one, right? 230 for one. So what you need to understand is that there were 230 aggressive sellers, and there was only one aggressive buyer. This was at the price 57.58, 0.75 on ES, right? It could be on any stock. So what this means is that, yes, sellers are aggressive, but are the sellers being rewarded? Well, the answer is no. And the reason why they're not being rewarded is because this zone is held. So this is the first thing to understand. When you see a lot of red, but the market has failed to break below the zone, it shows you that the zone is strong, that the zone is active. And this is the most important thing to understand, right? The zone is strong, the zone is active over here. This is the most important thing to understand. So once you have a very strong and active zone, what you are basically seeing is you're seeing aggressive sellers, right? These are aggressive sellers. But the thing with them is that aggressive sellers fail. Because if these aggressive sellers were actually successful, they would break the zone and continue lower. But of course, they haven't done that, which means the zone itself is strong. We should be buying from this zone. So this is the first thing to understand about delta, right? The second thing you want to look at is the volume. So the volume at the ends of these candles, particularly at the bottom, dries out. We see 54 for 0, we see 6 for 0, we see 25 for 0. So these are smaller numbers at the bottom. So when you see smaller numbers in the bid and the ask, it means the total number of transactions for these prices are decreasing. A decreasing volume simply means price action and the buyers and sellers are no longer interested at these areas, right? We can see a slow down of volume over here, slow down of volume over here. We also see a slowdown of volume over here. So we're seeing a decrease in volume, right? Now this final candle, this final rejection candle before the big move up is probably the most interesting, where if you look here, we see a lot of zeros over here, right? I want traders to understand we see 0 for 30, we see 1 for 25, 0 for 29, we see 0 for 43, we see some zeros at the bottom over here. So what you need to understand is when you see zeros, it means the market isn't interested in these prices, right? The volume is low, the volume is drying up. So when we come into this level, I want you to understand the volume here is drying up. So when think about it from an intuitive perspective, if you see the volume drying up and you see a lot of sellers failing, what this means is that the buyers and sellers are not interested in these prices at this level and the sellers have failed. So that means the market can only go in it can only go in one direction now. Because if sellers are not being rewarded and the market has a low volume, the market can only go up because sellers have failed, because there's only buyers and sellers. So you need to get simple with your trading, get mechanical, and this can remove all of your emotion. We also see here at the bottom, we see 472 for 265. So this means that there's almost double the amount of aggressive sellers than there are aggressive buyers. Despite that, we were still able to maintain this level over here. This for me confirms the level. So we've read order flow in just the space of 20 minutes. And from here you can catch, I think this is about 20 to about a 40-minute trade you could take them. I exited round about here in this position, about a 20-minute trade, catching this overall kind of scalp move over here. So this is how you read order flow with ICT concepts. So if we bring this back to the regular kind of candlestick concepts, what I want traders to take away from this is you want to understand the following. Let's go back to a regular candlestick chart. So on the candlestick chart, what I would like traders to understand is this, right? M15, right? We have a 15-minute fair value gap. We have a 1-minute entry, and we've just confirmed everything with the order flow. So let's hop up to the 5-minute time frame and see how you can apply this, right? So what we can see is we can see here price has given us our overall entry model. So when we break this down candle for candle, we saw a lot of aggressive sellers in this region. But of course, none of them were rewarded, right? So we can see here price has failed to break this level. We've seen price break, retest, and hold. So this is where your entry could have been. And if you remember from the regular candlestick chart, we saw a lot of aggressive sellers here, a lot of aggressive sellers over here. In fact, just to refresh your memory, what we can see is we see a lot of aggressive sellers here. We see a lot of aggressive sellers here, and we see a lot of aggressive sellers here, but none of them have been rewarded. And so this gives us indication to take buys from this particular level. And now from here, I just simply target a nice 1 to 2, 1 to 3 risk to reward, right? This is now 1 to 2.5 risk to reward, right? So again, it's understanding the scalp nature of the market. And the only way you can scalp the market is by reading order flow at key levels. So if there's nothing you took from this video, I just would like you to understand that everything comes down to buyers and sellers. If you can read the buyers and sellers, you can read the volume, you can read the order flow, it becomes very simple to catch these high risk to reward trades, right? So if you like this video, give it a like, give it a thumbs up. If anyone is interested in mentorship, just drop me a comment below and I'll happily send you the link. And I look forward to seeing all of you in the next one.